Historically, January 2022 is the worst January for the S&P 500 ever. Yes, you heard that right. So with the current bloodbath in the market, many are fearful and some even resort to panic sell. So in this video, I'd like to share some of my reflections as well as reminders to myself during this volatile period. So firstly, logic over emotions. Use logic and not emotions to guide your investment decisions. It definitely sounds easier said than done because just imagine if you were to have a stock portfolio that has been down more than 20% and you're losing thousands of dollars every day. So all these losses that you're currently facing might trigger your emotions and as a beginner investor you might think that is it time for me to sell? Why is it that my stocks are not doing well? Of course, this is actually the worst period to sell your stocks, so hold on your horses. And more importantly, you should ask yourself, even as the market and the economy has changed, has the underlying business actually changed? And if the answer is no, the company has strong fundamentals, then you should love the stock even more when they are at a discount. So as Baron Rothschild once said, buy when there's blood on the streets, even if the blood is your own. Volatility is a test of our temperament as an investor. Second takeaway is don't dig a deeper hole to make up for your losses. Did you know, psychologically, we actually experience twice as much pain from a single loss as compared to a single gain. It is our human nature to be risk averse, and this can be harmful to us as investors because it causes us to do two things. Firstly, we will hold on to losers in our portfolio because we believe that these stocks will rise up again. On the other hand, we sell off the winners way too early because we think that the stocks will go down and it's probably time for us to lock in all the profits. This is also known as the disposition effect in behavioral finance. So what should we do instead? Often, we're actually better off if we do the exact opposite. Yes, you've heard it right, the exact opposite. Sell off the poorly performing stocks and bite the loss early and hold on to the winners which are actually rising because they can actually withstand the current environment. Of course, this comes with a few important caveats. So for the so-called losers in your portfolio, the reason for poor performance is due to the company fundamentals and also due to deteriorating moat and margins. Whereas for the winners, the good performance is attributed to having a sustainable and long-term growth. If you've enjoyed the video so far, do remember to hit the subscribe button and also drop a like because it can tell the algorithm that this is helpful content and we can share this with more people. And oh, did I mention it's free? Lesson number 3, it's all about the stomach and not the brain. In this current market condition, growth stocks are being punished heavily because higher inflation is a huge worry for fast-growing companies. Higher inflation will eventually mean higher interest rate and higher discount rate for future cash flows. So this drawdown actually shows us the importance of having a diversified portfolio and one that is suitable for your risk appetite. For example, someone with a portfolio of 90 to 100% Tesla would be in much more anxious and stressed out position compared to someone who has owned multiple stocks across various industries, and also more importantly, the stocks have different exposure to risk. So as Peter Lynch says, the key to investing is the stomach and not the brain. Quoting from Peter Lynch, he says, "I've always said, the key organ here isn't the brain, it's the stomach. When things start to decline, there are bad headlines in the papers and on television. Will you have the stomach for the market volatility and the broad-based pessimism that tends to come with it?" And the last takeaway I have is to simply shut up and wait. When we're in the valleys of the stock market like right now, it feels like this will go on forever and ever. But it helps to take a step back and think about the long-term picture. Because when we zoom out and look at the bigger picture, this will just be another blip in history. You don't have to feel pressured to do anything because inaction is a form of action. And after all, if you're holding on to good businesses that have enduring moats and stable and durable competitive advantages, then you don't have to worry because your holding period should be forever. Remember that at the end of the day, investing is a marathon and not a sprint. So those are some of my reflections that I have during this current volatile period in the stock market, and everything that I said in this video shouldn't be treated as investment advice. You should of course do your own due diligence before you choose to do anything to your portfolio. If you're interested in watching more investing related videos, you can check out my playlist that I have over here, and also don't forget to subscribe to my newsletter and join the community where I share my ideas about tech, investing and mental models every week. That's all for now. My name is Tess and I'll see you in the next one. Bye!